Good evening, everyone. Time for another silver update. I decided to take a break from the silver and gold charts. There's really not a lot going on. Kind of going sideways right now. So I thought I'd do an analysis of Apple, and this is a chart provided by netdenia.com. You can click on the link below, which is an overlay of the Apple chart over the Cisco chart going back to about 1995 or so. It doesn't fully do justice to the run-up in Cisco because Cisco had made a significant run by 1995, but it still gives you a good picture of the bubble scenario we're looking at. So you can see here this black line was Cisco, and it reached a peak and crashed at the end of the dot-com era. And you can see that it was up 3,500% or something, and came down significantly. Now you can see that both of these stocks began to run up and then came down very hard in the financial crisis, and then with the March bottom, and we're going to look at the paper printing here when we look at the fiscal cliff, but when the March bottom began and the money printing began in earnest, then Apple took off and never looked back. Of course, Cisco, being a type of legacy company that had already gone through its growth phase, just kind of went sideways to down. So you can see that the bubble in Apple is that much larger than the one that was in Cisco, a 6,700% return. And I think if you calculate it all the way back to the lowest that Apple hit, you can actually find a 100-fold return. So a tremendous run-up in Apple stock. Now I predicted Apple is going to result in a tremendous crash, and I just want to take you to some of the fundamentals to show you why. So I've picked out some of the fundamentals here. This is the key statistics on Yahoo, and I pulled them both for Apple and for Cisco. So the market cap, you can see, for Apple is now $619 billion, and the market cap for Cisco is about $100 billion, so about a six-fold difference. So we want to compare some of the ratios so we can get an idea of what Apple's going to look like when it becomes just an ordinary company. Now, Apple doesn't pay a dividend. Well, I don't know. They announced they would. Let's see if those statistics are there. The trailing yield is 0.4%, so it looks like they are paying a dividend now. But we want to look at some of the key statistics here, such as price to sales, price to book, enterprise value. But let's look at price to sales. That's a pretty good indicator, and that's just the price of the stock versus the sales. You can see that the price to sales on Apple is 4, price to book is about 5. If we go over to Cisco, we can see that the price to sales is 2 and price to book is 2. So at that ratio, if we had just a correction in Apple back to the Cisco levels, then we'd be talking about it being cut in half, and that would imply a $300 price on Apple, and of course that would be a tremendous crash. Now normally those things overcorrect, so let's look at some other things here to try to get the fundamentals in view. You can see that Cisco Systems has $46 billion in revenue, and Apple has $148 billion in revenue, so about threefold. So if we just use the revenues, and again these are just rough statistics, if we use the revenues, then that would imply a stock price of 3 times that of Cisco, and that would imply a $60 price for Apple, and that would imply a 90% collapse in the price of the stock. The gross profit on Apple's $43 billion. The gross profit on Cisco is $16 billion. Again, that's about threefold, so that would imply a 90%. I'm sorry, that was total debt. 28. So we're talking 43 versus 28. So that's even worse. That would actually imply a $40 price on Apple. If we went to net income, that's after, well, we want to look at EBITDA. The EBITDA on Apple is 55. The EBITDA on Cisco is 12. So that's about a fourfold difference. That would imply a price target of $80 on Apple. And then the net income is $8 billion. And the net income on Apple is 40. So again, that's about a fivefold. That would imply about a $100 price target on Apple. You can see the total cash that Apple has is about 27 billion with no debt, whereas Cisco has 48 billion with 16 billion in debt. So Cisco actually has more cash. So just looking at those numbers, it seems clear that Apple is in a tremendous bubble. You have to remember that it's not, stock prices are not based upon current numbers, but they're based on projected future growth. With a $600 billion market cap, how much can Apple grow from here? I really can't see it. At some point, Apple's going to have to transition the way that Cisco transitioned and just become an ordinary company with earnings and dividends, etc. When that happens, I don't know how far Apple's going to go down. Some of the numbers imply down 90%. Some imply cut in half. But you're going to see a tremendous drop in the price of Apple. I don't know what the catalyst is going to be. There always is a catalyst. No one can know until the news is announced. There will be a catalyst. And when Apple is cut in half or more or worse, then I'll be here to remind you about that. Now let's get over to the questions of the night. There's a number of them. Does buying Fizz change paper value? This is from Mars. Brother John, still loving the vids. Keep up the good work. Question: since the paper value of silver dictates the physical price, how does buying physical ever directly affect the paper price? If a billionaire bought the year's supply of silver, would that move the paper market by itself, or would the paper market move on the views of such a purchase? I'm guessing in order to move the paper market with a physical purchase, you'd have to buy the contracts, then take delivery. I thought it would be interesting to chart the physical bullion sales against the paper price to see how they correlate, but don't have the time and the know-how to make it happen. Thanks again, Mars. Well, you've got to understand that the game that they're playing is they have decided to run this to end game. And when I say end game, what I mean by that is that they are not going to let the physical price of silver rise until they are absolutely forced to. And that is only going to occur when there are actual physical shortages. And that's going to mean that there just isn't the silver available that needs to be used in industry or is demanded by investors. They're willing to get down to the last ounce before they let this game end. And of course, because they've done that, there's a lot of things they could do. They could let the price rise dramatically here, and of course that would get the mining ramping up, that would get the recycling ramping up, and there's a lot of things that could ramp up and make it so the shock is not so dramatic. I covered in one of my Office series I did recently about primary silver mines and why there aren't any primary silver mines. And of course, as Jeff Nielsen has pointed out on Bullion Bulls Canada, that the determination of whether something is a primary silver mine is based upon the price of silver. The reason why there are virtually no primary silver mines is because the price of silver is too low. So they've decided to run this to the end game, and because they've decided to do that, and we're going to see this when we look at the fiscal cliff, it's going to be a catastrophic event. With as far as the paper and the fiscal cliff, it's going to be a catastrophic default or a catastrophic hyperinflation, and with silver it's going to be a catastrophic explosion in the price. when they finally run out of that last physical ounce that they can't fake with the paper. And next question, our daily shenanigans. This is from Feb 32nd. And the question is, hey, Brother John, thank you so much for all you do. I just finished reading Reminiscences of a Stock Operator and have been keeping my eye on the markets. Have you noticed how oddly silver has been trading today? I'm starting to agree with you. So many markets appear that they are propped up. The S&P 500 or forced down silver, Iranian rial. In Rickard's Currency Wars, he describes situations very similar to this, with presumably the U.S.-Israel having a fire sale on their covertly acquired mounds of reals, with JP Morgan finally being investigated for pocketing Bear Stearns investors' funds and QE ad nauseum. Do we really just have a few months until the next major financial oops is discovered? The FT reported over the weekend that 70% of investors believe another major correction recession is coming in the next year. If this is true, should it be priced into the market and big banks, etc., protecting themselves with puts and alike, creating new paper wealth from falling paper wealth? We can't be the only ones planning ahead with so much of the world long stocks yet holding puts. Won't we see flat trading as we have seen in the past weeks? Effectively a strangle on the market. Any catastrophic fall will mean catastrophic wealth for those who hedged, with the Fed more than eager to absorb as much counterparty risk as they can find. Another great excuse to print. The music has been off for 40 plus years thanks to Nixon and LBJ, yet we keep finding ways to make this abomination work. Aside from annoying underreported inflation and selective U.S. default to foreigners, won't we still? Thanks again. Well, we still will continue until we can no longer. As Jimmy Rogers has pointed out many times, if it were possible for everyone to just invest in markets and make profits, then no one would work, and that's obviously not possible. So there is an end game scenario. No one knows when that's going to be. Again, when I look at the fiscal cliff situation, we can see that it is bearing down on us rapidly, and it's coming soon. I can't say when, but it's definitely coming soon. I have to say about the markets being propped, yes, they are propped. We really don't have real markets anymore. And as far as the rial, I don't know what's happening with that. If Iran really has the currency, they could defend it. I don't really know what's going on, but the rial is clearly collapsing. We'll have to wait and see how that unfolds. And next question, cashing out my 401k. I'm going to begin by saying, this is from Barb, I'm going to begin by saying that, again, I don't give financial advice, so I'm just going to give some of my insights. Hi, Brother John. For years, I wanted to get my $100,000 out of my employer's 401k, but the plan did not allow for withdrawals. My employer has now decided to terminate the plan on December 31st, 2012 and allow everyone to move their funds to a SEP IRA. First question, what is the probability that the dollar will collapse before then? I have all my money in the money market since I don't want to risk a stock market plunge before December 31st. If collapse is likely before then, I should move to stocks. Second question, my husband really doesn't want me to cash out the fund and buy silver. If I do a gold-backed IRA, are there any protections that the trustees of gold won't steal it? Would you give me the names of several that you would recommend? Should I risk my husband's wrath, take the tax hit, buy the silver? He also has a 401k which he will keep in stocks and bonds, so I guess we're covered, collapse or not. A Smart Money article suggests Sterling Trust Company, American Estate and Trust LLC, Gold Star Trust Company, and the Entrust Group. Most trustees will arrange for the physical storage of coins and bullions with the Delaware Depository Service Company in Wilmington, Delaware. I've never heard of any of these. Well, that's a difficult decision that a lot of people are facing. Again, I can't give financial advice on that. But if it were me and I had $100,000 in a 401k that was going to have to be moved to an IRA, I would look very closely at the IRAs that are available. I know that Silver Doctors is offering a IRA. There are some others. I just don't know enough about this. I know that Dollar Vigilante has talked about forming offshore LLCs and things like that. But you really have to make a decision as to how bad you think the collapse is going to be. I personally believe the collapse is going to be the worst thing that anybody has ever seen in the history of the world, and that we're going to see an evaporation of paper assets, so that when the music stops, I don't even know how bad it's going to be, but it's going to be terrible. And I've covered James Turk and Mike Maloney as well, and these are going to be vaults that they have. They're audited. Those are probably the first pick amongst people who are very leery about the U.S. government seizing their assets and also having a safely stored physical asset. But then again, there's nothing that replaces having physical silver in your possession, because you just really don't know how bad things are going to be. And my suspicion is things are going to be really, really bad, probably worse than anyone can imagine. And last question from Freedom Fighter: does anybody really believe this? Does anybody really believe this? Australians suddenly richer as statisticians find $325 billion. The revision is worth roughly $14,000 for every one of the country's 22 million people. Woohoo, cannot believe can't wait to receive my share, as if anybody will really get that printed money. Now, if you go and look at this article, it's really just talking about the household assets, and I really don't know what is behind this. I saw that cross the wires, and it kind of surprised me. They're talking about the assets of people in Australia being much higher than they thought. Now, I thought that for some time, and I remember during the 2008 crisis, I had picked probably one of the best plays that I thought was available was the Australian, the Aussie currency versus the Japanese yen. And you can see that during the 2008 financial crisis that there was a tremendous collapse in the Australian dollar. Back here you can see we're trading at roughly 105, and we collapsed down to 55 or so. So compared to, and this is very similar to other currencies, not quite as extreme. This was the most extreme, and nearly a 50% collapse in the value of their currency. I thought that was a ridiculously overdone sell-off. And let's see if I can pull the Aussie US dollar sell-off. Not nearly as dramatic, but if you would have taken the other side from a drop of nearly 1 down to 60, if you would have gone long there, you can see it's actually turned around and gone the other way. I always thought that was a ridiculous plunge, considering the positioning of Australia in regards to geographically next to Asia and the natural resources that they have. I think that Australia is very well positioned, and barring some recent rumors of potential war with the United States, looking at setting up a bunch of bases there, possibly to make a standoff against China, barring something like that, I think the situation for Australia economically looking forward is very positive. So let's get to the main topic of the night, and that is an article that just hit the wire fairly recently from Zero Hedge, and this is about the national debt, the fiscal cliff. And we got the debt figures today that were the new fiscal year, because if you remember, the fiscal year ended September 30th, and we got the new figures, and we had a jump in the national debt of $93 billion to $16,159 billion. Now, the national debt limit is around $16.4 trillion, so we've jumped very quickly towards that. Again, it's October, and we're coming on the election. And so it's going to be a very close horse race to see if we hit this issue before the election or if it hits right after the election. It's going to be very interesting. There's about a 1-month countdown to some very, very interesting times. So there's a link here. I'll read this real quick and then go to the link. September 30th was the last day of fiscal 2012 for the U.S., which explains why, despite the barrage of debt issuance in the past month, the year closed with total debt of $16.06 trillion, a modest increase of just $50 billion in the month. Luckily, moments ago, we got the first DTS of the new fiscal year, which eliminated any residual confusion we had. As of the first day of fiscal year 2013, total U.S. debt soared by $93 billion overnight and is now a record $16.159 trillion. One can see why Tim Geithner wants to push all the debt under the coach for as long as possible. And the scariest thing is that the actual increase in Treasury cash was a mere $11 billion. But wait, there's more. As a reminder, final Q2 U.S. GDP was recently revised lower by $20 billion, which if we extrapolate into Q3, leading to a nominal GDP of $15.71 trillion, means that as of today, U.S. total federal debt to GDP is 103% and rising 1.5% per month. So those are some scary numbers. Now I decided to break those down a little bit farther. You can click on the links that are here. You can just go to debt to the penny. That is this link here from Zero Hedge, and that's to the Treasury site, and you can pull any dates you want. I decided to pull all the way back to the year 2000, and I just wanted to do a quick and dirty analysis of the various fiscal years. So let's just look at a couple here. Let's go to 2005, and you can see the end of the fiscal year there. 930, we had about 7932, and then we went to 7970. So we had about, and 14 before that, so 20 maybe. We had about a $50 billion jump right there. And the thing we want to look for is what happens over the next month. So we'll look at a few of these here. We'll go to 2006, and you can see that we had about 8.5 trillion, and we jumped to about 8.55 trillion. So we want to go and look out. Well, we actually have 8.473. We had the big jump on that last day. So really, we're about 8.49 or so. We had about a $60 billion jump. We want to look from here at about 8.49 to 1 month out on the 29th of October to get an estimate of where we're going to be, and you can see 562. So pretty big jump there. Let's go out to 2007, and we get about 8.9, 8.9, almost 9, and then you get that 60 right there, and then a month out we're looking at 70. So that one didn't increase that much. On to 2008, we get about 9.945, 9.8. So pretty big jump again on one of the last days. You can see we went over 10, and then a huge jump 124. And if we go out to the end of that month, you can see 525. So this is going to be a big outlier, and this is actually very interesting because this was an election year. So you can see that at the end of the fiscal year, we had about 9.95 trillion, and we jumped a month later to about 10.5 trillion. Now that's going to be about a $600 billion increase in just a month. So the question is, when we get down to the very bottom here, you can see we had about that 16. We were running at that 16, and we had that big jump here to 16.159. We know that the national debt limit is about 16.4. I think it's 16.397. Now, if we get that same 600 like we had in the last financial crisis, by the end of October, you can see we're going to be at about 16.6 trillion, and if we take percentages, we're even going to be higher. We could even be approaching 17 trillion if we get that same type of blowout. So it's quite possible that the fiscal cliff is going to arrive this month. Will it arrive before the election? Will it arrive after the election? I can't say for sure, but with the election coming up next month, with the 2012 prophecies and all that craziness coming up the next month after that, we're looking at some very, very serious fireworks coming up in the very, very near future. And of course, we want to go to the silver price. That's why you have to stack physical silver, because if you think about it, that $93 billion increase, that 1 month $93 billion increase, if we look at how much silver that's going to buy, that would buy 2 billion plus ounces of silver. And that's just an increase in 1 day. So you can see that the paper is exploding. How long will it be until the paper money that they are printing feeds its way back into the system? When are the people who are the beneficiaries of all this printed money, when are they going to begin to head for the exits and stop taking printed money as a payment on printed money and begin to invest that printed money in hard assets? You can see by the raw numbers, $93 billion, and they're just increasing exponentially. You can see that if any of that money, even just a tiny portion of that money, began to flow into the precious metals, we're going to see an explosion in the gold and silver price. Silver will rapidly take out that $50 price, and I think once silver takes out that $50 price, the move towards 100 is actually going to be very swift. And we'll talk to you next time.